In a long-term oriented portfolio, closed-end funds have a role to play. For example, when it comes to municipal bonds, which is one of the largest categories of closed-end funds, what we tell our investors is to use them as though they are the longest end of your bond ladder. In other words, the same way that you expect a 5-year bond to produce less income, but also be less volatile than a 30-year bond in your ladder, a 30-year bond will generally produce less income and be less volatile than a closed-end fund, which itself is a perpetual vehicle. And so, as you ladder out a portfolio to generate increasing amounts of income as you go out longer, and you willingly also accept slightly more volatility as you go out longer, a closed-end fund fits philosophically in with a bond ladder in that same way. So that's, for instance, how we would tell someone to use it alongside a conventional fixed income account. On the equity side, the same things are at work in closed-end fund land that are at work in other equity investments. The reason to use closed-end funds is, simply put, you can get them cheap. If you can buy some number of assets at any number of cents on the dollar, you have a material advantage over buying those assets at full price. When it comes to total return investing, one of the things that's actually an interesting wrinkle that investors need to understand about a closed-end fund investment. Closed-ends are regulated under the 40 Act. And the 40 Act mandates that in order to avoid double taxation, in other words, no tax at the corporate level, the way that if Johnson & Johnson earns $1 of income, it gets taxed at the corporate level, then they pay a distribution to their shareholders, it gets taxed again. Closed-end funds don't have to deal with that. But in order to avoid that issue by the IRS, they are mandated to pass through all of their gains and all of their income to their investors so their investors can answer for any tax consequences that there are. As a result, closed-end funds that are geared for total return investing are going to pass through the majority of those returns, the majority of positive returns, are going to come through the distribution. So therefore, it's important that investors who invest for total return understand that counting how much their distribution has added up over the years is absolutely relevant to what the total return has been for that investment. In other words, a closed-end fund's distribution, even if it's not an income-centered strategy, really depends on keeping track and accounting for how much distribution, how much cash flow has come off of the investment.
For more information and data on closed-end funds, visit our sponsor, CEFconnect.com, the authority on closed-end funds. This is Closed-End Fund News.